Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon to find the juicy bits. And today we're diving into a report that is basically bank speak for things are looking pretty interesting. This is an amendment to Bank of Montreal's annual report for the year ending the 31st of October, 2025. Why an amendment, you ask? Well, it seems they just had to tweak a date on their management discussion. But hey, even small corrections can tell a story, and we're here to decode that story, especially the part about where the money is and where it is going. First off, let's talk about the sheer number of shares. As of the 31st October 2025, Bank of Montreal has a massive 708,905,679 common shares out there. That is a lot of ownership slices. And they also have various classes of preferred shares like Series 44, 48, 49, 52, 53, and 54. All with specific conditions attached, often related to them being non-viability contingent capital. Think of these as special shares that might get a bit tricky if the bank gets into serious trouble. Now, about this amendment, this isn't a whole new report, just a little polish. They're correcting the date of their management's discussion and analysis. It's like when you write a letter and then realize you have to fix a typo in the date. Nothing earth-shattering, but it shows they are paying attention to the details, which is usually a good sign in the financial world. This section, the management's discussion and analysis, is where the company's leadership basically tells you their side of the story about the financial performance. They break down what happened, why it happened, and what they think will happen next, all while trying to put their best foot forward. And here are the nitty-gritty financial statements. This is where the numbers live. We see the bank's performance laid out for the fiscal year ending the 31st of October, 2025. Let's look at the company's financial health. One key indicator is their share count, which we already saw is over 708 million for common shares. This gives you an idea of the scale of the company. We also see mentions of preferred shares being redeemed or issued. For instance, on the 12th of November 2025, they redeemed some capital notes and preferred shares. This shows active management of their capital structure. Then, on the 29th of July 2025, they issued new capital notes along with a related set of preferred shares. This is a strategic move to manage their funding and capital requirements. The filing also touches on risk. They're detailing their market risk exposure, and this includes value at risk, or VAR. Think of VAR as a number that estimates how much money they could lose on their investments over a specific period given normal market conditions. With a certain level of confidence, it's a way to quantify potential downside. They're looking at different types of risks, including equity price risk, which is the risk that the value of stocks they hold will drop. They are also keeping a close eye on currency risk, the risk that changes in exchange rates will affect their financial results, and interest rate risk, the danger that rising or falling interest rates will hurt their investments or borrowing costs. A big part of a bank's business is commitments to lend money. They're showing commitments to extend credit in different timeframes from not later than 1 month to later than 5 years. This tells us how much money they've promised to lend out in the future, which is a crucial aspect of their business operations. Similarly, they're detailing their involvement with letters of credit. These are essentially promises from the bank to pay a seller on behalf of a buyer. If certain conditions are met, it is another way they facilitate business transactions. Then there are backstop liquidity facilities. These are like safety nets, where the bank agrees to provide funding if a client can it elsewhere. It is a way to support their clients and ensure market stability, but it also carries its own set of risks. Looking at their commitments and facilities, we see how they're structured across different maturity periods. For example, under commitments to extend credit, they list amounts for not later than 1 month, all the way out to later than 5 years. This breakdown helps investors understand the timing of potential cash flows and future obligations. We also see information on repo-style transactions. These are essentially short-term borrowing arrangements, often using securities as collateral. They are a common tool for managing liquidity in the financial markets. This category encompasses derivative and repo-style transactions, highlighting the bank's engagement in more complex financial instruments and short-term funding activities. They're also breaking down some of their exposures by country, showing specific figures for Canada, the US, and other jurisdictions. This gives us a glimpse into their geographic diversification strategy. The report also shows scenarios for interest rate changes like a 100 basis point increase or decrease. This is an analysis of how their financial results might be affected by a significant shift in interest rates, a common practice for banks due to their sensitivity to this factor. The bank is detailing its exposure to equity price risk. This is crucial because fluctuations in stock markets can significantly impact a financial institution's portfolio. They are providing figures for the bottom of range and top of range, as well as the average. This gives a sense of the potential variability of these risks. Similarly, for currency risk, they're presenting a range of potential outcomes, indicating the level of uncertainty they are managing with respect to foreign exchange movements. And for interest rate risk, again, we see their assessment of potential impacts with figures for the bottom, top, and average scenarios. This shows they are actively modeling and disclosing how interest rate shifts could affect them. Overall, their market risk disclosures show the bank is assessing potential losses from various market factors like equity prices, currencies, and interest rates, providing ranges and averages to illustrate potential impacts. The consistent use of average member across different risk categories suggests they are providing metrics that represent a typical or smoothed out exposure rather than just a snapshot in time. There is also a mention of exceptions to trading book market capitalized as per standardized approach member. This sounds complex, but it essentially means they're disclosing any deviations from the standard method they use to calculate market risk capital for their trading books. This level of detail is important for transparency. Now, let's put on our investor hats and look at the big picture here. Bank of Montreal, or BMO as it is sometimes called, is a major player in the financial world. This filing is an amendment to their annual report, which means they've already reported their main findings, but they've gone back to correct something minor. That is not a red flag, but it does show the importance of precision in these documents. The sheer volume of data here, from share counts in the hundreds of millions to detailed risk exposures across various categories and timeframes, speaks to the complexity of a global bank. They're not just dealing with loans and deposits. They're managing a vast array of financial instruments and exposures. What is really striking is the detailed breakdown of their commitments and facilities. When you see them reporting on commitments to extend credit, letters of credit, and liquidity facilities, it paints a picture of a company deeply integrated into the flow of commerce and finance. They are enabling businesses to operate and manage their cash, which is the core function of a bank. The risk disclosures, particularly for market risks like equity prices, currencies, and interest rates, are also critical. The fact that they're providing ranges and averages for these risks shows a sophisticated approach to risk management. They're not just saying we have risk, they're quantifying it and showing how they're thinking about its potential impact. This is what sophisticated investors want to see. However, with great scale and complexity comes great responsibility and potentially great risk. The mention of non-viability contingent capital on their preferred shares is a key detail. It means that if the bank gets into severe financial distress, these shares could be converted into common shares or even written off. It's a mechanism designed to protect the bank and its core operations during extreme crises. But it is a stark reminder of the potential downside for those particular investors. Looking at the overall strategy that these disclosures hint at, BMO appears to be actively managing its capital, assiduously monitoring its diverse risk exposures, and playing a significant role in facilitating business through its various credit and liquidity facilities. The geographic diversification is a positive sign, spreading risk across different economies. In conclusion, this amended filing, while minor in its amendment, underscores the thoroughness and complexity of a major financial institution's reporting. BMO is demonstrating a commitment to transparency by detailing its financial structure, its forward-looking commitments, and its comprehensive approach to managing financial risks. The company seems to be navigating the intricate landscape of global finance with a focus on both growth and stability, though the intricacies of contingent capital instruments highlight the inherent risks in the banking sector. Alright, that is our breakdown of Bank of Montreal's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.